Launches Threads to rival Twitter. It says 10 million people signed up in the first few hours.
3, 2, 1.
And the money transfer group Cab Payments debuts on the London Stock Exchange in one of the biggest flotations this year. Good afternoon, this is Ian King Live, Business Live with Ian King. The chief executive of HSBC UK has insisted savers can get good interest rates if they shop around. Ian Stewart was speaking as he and other bank executives met officials from the Financial Conduct Authority amid accusations that lenders are profiteering from rising interest rates. They've been accused of being quick to raise mortgage rates while failing to pass on the benefits to savers. Here's what Ian Stewart told Sky's Paul Kelso as he arrived for the meeting.
And what will you say in respect of the savings rates?
I don't know, because I don't know what I'm going to be asked.
OK.
There's some great savings rates out there, though. Just encourage people to get online, get some great savings rates.
Our business correspondent Paul Kelso is at the FCA's headquarters in Stratford. Paul, any readout yet from the meeting?
Waiting for a formal statement, Ian, from the meeting, but I've just spoken to Sheldon Mills of the Financial Conduct Authority. He was pleased that when the invitation, was it an invitation or was it really an order, given that the Chancellor had expressed a concern about the level of savings rates, whatever it was, it drew bosses, senior figures, chief executives, almost all the chief executives from 9 of the biggest banks in Britain arrived here at the office to talk about whether savers are getting a fair deal. We've seen mortgage rates, 2-year fixes rising above 6.5% because the bank rate has gone up, as we know. But the savings rate for instant access is lagging nearly 4 percentage points behind. You can get just over 2.5%. You tie your money up, you can get a better rate, certainly if you tie it up for a year. And that is what Ian Stewart was talking about when I spoke to him on the way in. But speaking to Sheldon Mills just now, he shared the view that there are good rates out there. What he wants the banks to do is ensure that as many customers as possible get access to those rates and people are encouraged to save. This is what he told me.
Savers are getting value, and I think when you think about value in retail banking, you've got to think about the wide range of products that people have: current accounts, lending products, credit cards, savings and mortgages. The banks provide all of those services as well as lending to small businesses. In that context, there is value being provided. We have, though, been working with banks for a number of months to just ensure that as base rates go up, the right level of value is going through to all of those customers.
The question is, what's the FCA going to do next? Well, there will be a report at the end of this month in which they'll set out a little more formally the actions that have arisen out of today's meeting. Bank Boss is not massively keen to talk about it. Charlie Nunn from Lloyds did stop and talk to me on the way out. He said it was positive. He also thinks there are good rates out there, but perhaps he would, wouldn't he? But the banks clearly realise they are under pressure here. This has some political weight at the moment, given the wider cost of living crisis. So, should be said, we're focusing on savings here. That's a nice problem to have in this economic climate. Most people, many more people, are worried about how they can get to the end of the month with their bills rather than how much they can salt away and what deal they'll get for it. And the pressure, I suspect, in this debate around where bank rates are and what rates are offered to borrowers and lenders will soon switch as more and more fixed-rate mortgages come up and people find themselves facing much increased monthly bills to meet their mortgage. The pressure here and on the banks and from the Financial Conduct Authority will be how people are treated fairly by the banks as they begin to struggle, rather than what they can do with what money they're lucky enough to be able to put away.
Thanks, Paul. Facebook's parent company Meta today unveiled its long-awaited competitor to Twitter. The app, called Threads, allows users to publish posts of up to 500 characters long and includes links, photos and videos. Meta's chief executive, Mark Zuckerberg, used his own Threads account to announce that the platform had signed 10 million users during its first 7 hours. Well, joining me now is the technology journalist Will Guyot, who's also a former Meta employee. Will, welcome to you. What's motivated Meta to do this?
There's a few things, I think, Ian, that they very clearly wanted to enter into this space for a long time. We've probably nearly all forgotten that Mark Zuckerberg tried to buy Twitter in 2013 for $500 million. Didn't get anywhere with that, and then quickly moved on to buy Instagram for $2 billion. He's always fancied the idea of a text-based service. They've been working on it for a while. I kind of truly believe that the little bit of rivalry and needle between Mark Zuckerberg and Elon Musk has turned this into reality. I also do not think it is a coincidence that it is suddenly launched this week after we had a weekend of truly bizarre behavior from Elon Musk over at Twitter.
But Elon Musk is struggling to make Twitter profitable. Why would Mark Zuckerberg want to set up a copycat which has no guarantee of being profitable itself?
Well, it will become profitable the moment he switches on advertising. That's the thing. It's being built within Meta's advertising network. They're not running ads on the platform right now, but the idea is this is another part of the Meta ecosystem where they can serve you heavily targeted adverts. It's very strange, Ian, as to the fact that we've all, or many of us, have seemingly jumped back into the warm embrace of Mark Zuckerberg after many people spending a great period of time questioning just how much freedom Meta had to use your data, selling it to others, and also selling or targeting advertising at you.
That's very interesting because there are rival platforms out there, the likes of Mastodon and Blue Sky, and not to mention Donald Trump's Truth Social. This feels like
that's the issue.
This, from what you're saying, stands a chance of taking business away from Twitter.
I think it will kill Twitter. I will go that far. And I will say there will be the people who want to stay with Elon Musk and his free speech platform. But the place where the audience already exists, Ian, is over on Meta's platforms. The number you were giving earlier of 10 million or whatever it was with Mark Zuckerberg, we're talking nearly 20 million now, just several hours on. When you consider that Twitter has stayed around the 350 million active users for about 5 years, even when it had Donald Trump tweeting from the White House toilet as every opinion as the leader of the leader of the free world. That platform never grew. Within the first 24 hours, this platform from Meta could have 10% of that audience already. So if Twitter was worth $40-odd billion when he purchased it, Fidelity was saying it was worth 15 billion potentially last week. Could be worth half that by this time next week. If users go, I've had enough of Elon Musk and his antics, I'm going elsewhere. If it really starts sticking and the people who've been using it for the first day keep coming back and more people keep signing up, you don't need Twitter anymore.
Very interesting that you make the point there about Elon Musk. I mean, do you think one of the strengths here is that Meta's been increasing its spending on platform moderation at a time when Twitter's been cutting back on its own?
Well, let me give you an anecdote I spotted this weekend. On Twitter, the whole film, the most recent Spider-Man film, only recently, a year or so out of the cinemas and still on Sky Movies and in all of those places, was posted in full to Twitter on Saturday evening. It stayed there on the platform before it was removed Monday morning. If something like that had happened on one of Zuckerberg's platforms or YouTube, it would have been removed by an automated system within minutes. That's the bonkers thing here. I don't know what Elon Musk has done in terms of, we know he's laid off an awful lot of people and he's claiming you didn't need all those engineers and specialists to keep this platform running. But anecdotally, we've seen the attitude towards copyright become very lax. But on the opposite side of that, independent experts, not people like me who don't like Elon Musk, are claiming that hate speech, etc., have rocketed on that particular platform. What Meta does incredibly well, it has scale. Mastodon and Blue Sky and all of those other places we've talked about simply couldn't cope with the number of users signing up at any one point. At the points where Mastodon has had big sign-ups splurges, it's often gone down or crashed, or you've not been able to sign up. Musk won't be able to compete with what the guys at Meta are able to do here. They've got the scale and they've got the engineers.
All right, well, we've got to leave it there. Good to talk to you today. Thank you. Some other business news stories for you now. And shares of cab payments have fallen by 10% this afternoon after the company made its debut on the London Stock Exchange this morning. Well, the company, which specialises in facilitating foreign exchange and cross-border transactions in emerging markets, was valued at £851.4 million at flotation, making it large enough to enter the FTSE 250 index. The flotation, one of the biggest so far this year, is being seen as a test of confidence in the UK stock market, which has seen a dearth of IPOs this year. I'm pleased to say the Chief Executive of Cab Payments, Bhairav Trivedi, will be appearing on Business Live tomorrow morning. The tour operator Jet2 predicted a strong summer today after reporting results that topped its last year of trading before the pandemic. Jet2, which now claims to be the UK's largest package holiday provider and third largest airline by number of passengers flown, reported a pre-tax profit of £371 million for the year to the end of March. That was up from a loss of £389 million during the previous 12 months, but it was also up 48% on the year to March 2020. Well, the company, which recently announced plans to begin flying from Liverpool John Lennon Airport from next March, said it would be offering 7.5% more flights this summer than last year. Activity in the UK house building sector slumped to its slowest level for more than 14 years. Outside the pandemic, it emerged today. The Purchasing Managers Index survey for the construction sector, in which anything above 50 represents growth and anything below that a contraction, came in at 48.9 in June. That was down from 51.6 in May. It was the first contraction for the sector in 5 months. But the reading for residential house building came in at just 39.6, meaning that activity contracted at the steepest pace since May 2020. S&P Global, which compiles the data, said that aside from the lockdown-related fall in house building, the rate of contraction was the fastest since April 2009. Now, there's a big shake-up of insurance regulation coming, with changes to the Solvency II rules that dictate how much capital insurers must hold and where it can be invested. The government and the industry say the reforms will allow significantly more to be invested in productive assets in future. Well, to that end, the Association of British Insurers has today launched a new investment delivery forum to help drive investment into UK infrastructure projects. Well, joining me now to talk about this is Hannah Gurgey, the Director General of the ABI. Hannah, very good to see you today. For those who haven't been following the stories, how does Solvency II inhibit investment?
Well, it's great to be here with you, Ian, today as we launch our Investment Delivery Forum. The insurance and long-term savings sector in the UK is a powerful institutional investor, and firms are already investing across the country in large-scale infrastructure projects. But the prudential regulatory framework, which was called Solvency II and in the future is going to be called Solvency UK, is being reformed by the government to enable investment in a broader range of productive assets. And we're excited about that because it means as an industry we can do more to deliver better returns for savers, but also to help power economic growth and do more to help the environment.
So how will this forum be driving that investment?
Well, the forum is going to be chaired by Baroness Nikki Morgan, who is the chair of the Association of British Insurers, and it brings together leaders from 7 founding members. There'll be household names that are familiar to you, Aviva, Phoenix and others. And that forum will oversee 3 delivery groups that are focused on energy networks, energy generation and housing.
Are those sectors deprived of capital at the moment because of Solvency II, though?
Those are the areas that we as an industry believe the UK will need increased investment if we are to meet the objective of net zero in 2050. And there are also areas where our industry has expertise and where we feel lessons can be learned to potentially apply to other areas across the country that would also benefit from investment. And
why those areas in particular? Because those are the areas that you feel are most in need of capital?
Our industry has a strong social purpose at its core, and the ABI has a purpose of investing in protecting people and planet. But as an industry, we have to have the interests of savers at the heart of everything we do. And we feel that investing in these types of areas across the country, in the regions, in the devolved administrations, is really going to deliver the benefit that people want in their retirement, but day to day will have a great impact on their everyday lives.
Are some of these long-term infrastructure projects, so for example, as risk-free as they may appear? I mean, you look at the situation with Thames Water right now, I'm sure members of the USS pension scheme are not delighted at how that investment's going.
All of our members and those that will be involved in the forum have to look at the risk and the reward and make sure there's a balanced approach that delivers the best outcome for savers. So we'll be working closely with other partners, central government, local government, as well as other bodies such as 3CI that have a strong focus on how to help green the economy and support neighbourhoods as they're going through the transition to net zero.
There's been a bit of anxiety in some quarters, not least from the Bank of England, that doing away with Solvency II or watering it down increased the risks for policyholders. What do you say to those people?
The reforms that will be introduced through Solvency UK will mean that the UK continues to have one of the most robust prudential regulatory regimes for insurance in the world. The policyholder protections remain in place, but what the reforms allow is investment in a broader range of productive assets, and that's for the good of the savers, but also for the good of our country.
All right, Hannah, got to leave it there. Good to see you today. Thank you.
Thank you.
Still to come here on Business Live, we'll be having a look at how the markets have finished this Thursday afternoon. Stay with us. Has rallied. Moderation, interest rates peaking.
I'm up at 6%.
The highest for 14 years.
Will that be the peak? Will it be a little bit lower?
It's closer to a potential crash.
So many words, so many meanings. But what do they mean for you and your finances? Stay up to date on Sky News.
I'm Martha Kellner and I'm Sky's US correspondent based here in Los Angeles.
It's turning everybody into, a crazy, violent drug addict.
How are you feeling?
I am angry.
Are you a hypocrite, sir? Will your candidates win?
I hope so.
I gotta be realistic. My sister's dead.
More than 4 weeks on, there's no murder weapon and no suspect. Mum, how are you feeling today?
Jeffrey said, you answer to Ghislaine, you just don't cross her.
I'm so excited.
Severe nightmares of these people coming in and just taking me in the middle of the night.
I've watched as whole towns were torn apart by natural disaster.
I'm alive and I'm thankful for that.
We take you to the heart of the stories which shape our world.
A lot of cases that I know are reported from Ukrainian missiles themselves.
Ambassador, with respect, I think that's preposterous.
It's like Emirates. It's like better. Fly Emirates, fly better.
Well, stocks in Europe have sold off sharply this afternoon. It's an absolute sea of red out there. That's on news that last month saw much stronger than expected private sector job growth in the United States, making the prospect of more interest rate rises likely from the US Federal Reserve. Look at that, the CAC off nearly 3.25 points on the session. It's a similar picture here in London. The FTSE 100 has finished down by more than 2%. In a broad-based sell-off, it's hit its lowest level this afternoon since the 20th of March. Leading faller in percentage terms is the gaming group Flutter Entertainment. Meanwhile, Next and JD Sports, both off there. That looks quite a sharp fall, but bear in mind those stocks have gone ex-dividend today. In other words, they're trading for the first time without the rights to the latest payout. So don't panic too much if you own those particular stocks. All of the house builders, meanwhile, have also fallen sharply on the PMI data. There are not too many blue-chip gainers to mention this afternoon, but United Utilities is ahead by 1.5% or so, and that is after it got a push from one of the brokers. Outside the FTSE 100, Currys is the biggest faller. It's off by more than 12%. That's after it reported a drop in profits and said it wouldn't pay a final dividend. You might recall we had Alex Baldock, the CEO, on our morning programme. The office space provider Workspace, meanwhile, is off by nearly 5% on a trading update, while the recruitment firm Robert Walters is off by 1%. That's after it reported an 11% drop in quarterly fee income. Well, it's a similar story on Wall Street right now. Wall Street is selling off very, very sharply on that jobs data. The S&P 500, the Nasdaq and the Dow Jones Industrial Average are all off right now by nearly 1.5% apiece. There's also been a sell-off in the bond market today. The yield on two-year US Treasury bonds has hit its highest level for 16 years. The yield, of course, rises as the price falls. Here in London, 10-year UK gilts, well, the yield there has hit 4.661%. That is higher than they were prior to or immediately after the mini-budget last autumn. You remember, of course, what happened then. On the foreign exchange markets, well, the dollar has strengthened on the jobs data. You can see sterling more or less holding its own there against the dollar. In fact, looking at that, the dollar's given some of those gains back as the afternoon's worn off because it's slightly behind against the euro right now as well. Has affected the oil price. So the oil price tends to work in an inverse proportion to the stronger dollar. Barrel of Brent crude, as you can see there, changing hands at $75.65 a barrel. That's off a little over 1.25%. Well, joining me now is George Lagarius. He's chief economist at Mazars. George, good to see you this afternoon. I mean, this job number, I mean, it's obviously fantastic news for the US economy in terms of the strength and resilience it's showing, but it does rather point to more interest rate rises.
Well, yes, OK, it's a strong labour number, but really the sell-off we're seeing is just a buoyant market that's rallied hard for 3 weeks, taking profit as it comes to terms with further rate hikes. And, you know, to be sure, I honestly don't understand what the surprise is. We knew that the labour market is tight. We knew the Fed would be hiking further. They told us many times. Investors seem to consistently underestimate the determination of central banks to focus on inflation. So really what you're seeing is taking profit. I think you would see more worries ahead if markets ever come to the conclusion that central banks will end up over-tightening.
George, do you think this makes it now inevitable that the Fed is going to have to tighten policy so much that we do get a US recession?
I think inevitable is a very strong word, but I think that's definitely the direction of travel. We had a very long period of very low interest rates, and then we printed a lot of money. And by the way, the last round of QE ended up in the pockets of consumers, which means it became very inflationary. And now we need to push hard towards the other direction. You know, in the US, I would not be surprised if we see a recession near the end of the year or earlier next year.
And in terms of when we start to get interest rate cuts, I mean, that looks like it's heading further out into the distance.
I think those who are expecting rate cuts in 2024 might be negatively surprised, unless we see a sharper recession than what we originally anticipated. I would put rate cuts maybe in 2025.
Now, George, I mentioned in the market report there, Robert Walters, pretty disappointing trading update for them. I mean, that is a pretty good barometer of the labour market more broadly, isn't it?
Well, yes, but look, what they said is reduced levels of candidate confidence and lengthening time to hire was signaled in the second half of 2022. And I hear that, but Robert Walters is not really an independent purveyor of macro data. I would read it more as anecdotal data. The labor market in the US, in the UK is very tight. Unemployment actually fell in April to 3.8% from 3.9. Job vacancies are roughly a little bit over 1 million, which is 63% higher than average. So I'd say that the labor market is still very tight.
And obviously that has a knock-on for wage inflation, which is obviously something the Bank of England is very worried about.
Yes, so the UK, more than other countries in Europe, has entered this wage price spiral, which is why UK interest rates now need to rise more than its developed market peers.
OK, George, got to leave it there. Good to talk to you this afternoon. Thanks very much indeed for joining me.
Thank you.
That's it from me for this afternoon. I'm back with another edition of Business Live tomorrow morning at 11:30. Hope very much to see you then. Don't forget, we'll be joined by the Chief Executive of Cab Payments, which made its debut on the London Stock Exchange today, one of the biggest IPOs so far this year. And I can also give you a little bit of breaking news from Headingley. The Australians have just been bowled out for 263, and Mark Wood got a fifer. Well done for him. Thanks for joining me today. Hope to see you again tomorrow. Cheerio.